Welcome to the Deep Dive. Today, we're really getting into something fascinating. The insights from, well, one of the world's most legendary investors.
That's right.
I mean, think about this. One company's overall gain from 1964 all the way to 2022 was nearly 3.8 million percent.
It's almost hard to grasp.
Right. Compare that to the S&P 500.
Yeah.
Still impressive, sure, at 24,708%. But it's just a different league entirely. This kind of performance, it's clearly not just luck.
No, absolutely not. And that's really our mission today, isn't it? We're digging into the 2022 annual letter from this investor.
Yep.
And this letter, it's not just numbers, although the numbers are there. It's packed with detailed data, but also, personal reflections, enduring wisdom.
So we're trying to pull out the key nuggets.
Exactly. What really matters for building long-term wealth? And how does this perspective go beyond just picking stocks? How can it help you make sound long-term decisions?
Okay, let's unpack this then. The numbers alone, just starting there, Berkshire Hathaway versus the S&P 500, it's frankly staggering.
It truly is. The sheer power of that sustained compounding and the outperformance, it's just remarkable. We're talking 19.8% compounded annual gain for Berkshire from 65 to 2022.
Compared to 9.9% for the S&P.
Yeah.
Almost double compounded.
Right. And that huge overall number you mentioned, 3,787,464% for Berkshire versus, just under 25,000% for the S&P since 64. It just paints such a vivid picture of consistency over the very long run.
It really does. The scale is just mind-boggling. So it makes you ask, right, what's the fundamental difference? How did they actually do that? Because it can't just be about picking a few hot stocks.
Yeah, and what's fascinating here is that the core philosophy really isn't about market timing. It's not about catching short-term trends.
Right.
They approach it through two main forms of ownership. First, you've got the businesses they actually control, often buying 100%.
So they're really running the show there.
Exactly.
Yeah.
They direct capital, pick the CEOs, and trust is absolutely paramount. Zero tolerance for personal misconduct, it says.
Okay, so that's one type. Almost like a private equity approach in a way.
You could say that. Yeah, very hands-on. Then the second type is the publicly traded stocks. Passive ownership, no say in management.
Got it.
But here's the crucial part. The goal for both is identical. Meaningful investments in businesses with both long-lasting, favorable economic characteristics and trustworthy managers.
So the underlying principle is the same.
Precisely, and the investor says it directly. Charlie and I are not stock pickers, we are business pickers.
Business pickers. I like that. What does that really mean in practice for you listening?
It means focusing entirely on how the actual business is doing, its long-term prospects, its health, not trying to guess which way the stock price will wiggle tomorrow or next week. It's a fundamental shift in perspective.
That makes sense. And the letter is honest, too, right?
Yeah.
It mentions it wasn't all smooth sailing. Near disasters like U.S. Air or Salomon.
No, absolutely, which, raises a really important question about the real secret. What led to what they call satisfactory results? The letter actually says their success was mostly the product of about a dozen truly good decisions. That would be about one every 5 years.
Wow, only about a dozen.
Yeah.
Over all that time.
Yeah. It wasn't about being right all the time on everything. It was about making a few really impactful choices over decades. It shows even the best stumble, but those big wins can more than make up for it.
Okay, so it's not just theory. The letter actually shows this secret sauce, as you called it, in action. These examples of patience and compounding, they're incredible.
They really are. It just lays bare the almost unbelievable power of holding on and letting dividends compound. Take Coca-Cola.
Okay.
They finished buying their 400 million shares by 1994. Cost $1.3 billion. Sounds like a lot, right?
Yeah.
But the annual dividend they got from Coke started at $75 million back then. By 2022, that same dividend stream had grown to $704 million annually.
Just from dividends. Wow.
Exactly. And that initial $1.3 billion investment, by the end of 2022, it was worth $25 billion.
$25 billion from 1.3.
It just shows you it's not only picking the right company, but identifying a great business and just holding it, letting time and compounding do the heavy lifting.
Is American Express a similar story?
Very similar. Purchases wrapped up by 1995, also about $1.3 billion. Dividends grew from $41 million a year to $302 million. And the value hit $22 billion by year-end 2022.
It's powerful stuff.
It really hammers home that message. The weeds wither away in significance as the flowers bloom. You just need a few big winners over time. And the letter jokes, it helps to start early and live into your 90s.
Right. So for you listening, the takeaway is patience pays. and small, steady gains can become enormous over decades.
Absolutely.
But to really make that work, you need to understand what's going on under the hood, financially speaking. Which brings us to how the letter talks about reading financial statements, specifically for 2022.
Yeah, this is vital if you connect it back to that long-term view. The investor really emphasizes looking at operating earnings. That's their preferred measure of kind of the core ongoing profitability.
Okay, operating earnings.
Right, which hit a record $30.8 billion for Berkshire in 2022. They contrast this sharply with GAAP earnings, the standard accounting earnings.
The ones you usually see in headlines.
Exactly. And the letter calls GAAP 100% misleading when viewed quarterly or even annually.
Why so misleading?
Because GAAP includes the ups and downs of their massive investment portfolio, the capital gains and losses. And those can swing wildly based on market sentiment, not necessarily the underlying business performance.
Ah.
They give a stark example from Q2 2022, operating earnings, a healthy $9.3 billion. But GAAP earnings, a huge loss, negative $43.8 billion, just because the stock market dipped.
That's a massive difference. So what's the danger if an investor just looks at that GAAP headline?
Well, the danger is you completely misjudge the actual health of the business. You might see that big GAAP loss and panic, thinking the company's falling apart, when really the core operations are doing just fine.
Right. The media mindlessly headlining those swings, as the letter puts it, can totally misinform people.
Precisely. The letter wants you to look past that noise. Another key financial point they discuss is insurance float, especially with the Allegheny acquisition.
Float. Explain that again. It's important, but tricky.
Yeah, it's basically the money insurance companies collect upfront in premiums, which they get to hold and invest before they pay out claims. Think of it like a huge interest-free loan from policyholders.
Okay, money they hold temporarily.
Right, but temporarily can mean years or decades. And it's this extraordinary asset, as the letter calls it, even though it doesn't show up that way on the balance sheet.
So it's like free capital to invest.
Essentially, yes. For Berkshire, this float grew from $147 billion to $164 billion just in 2022. And since 1967, it's grown 8,000-fold. It's a massive hidden engine for them.
An 8,000-fold increase. Incredible. Okay, moving on to another topic that gets a lot of airtime. Share repurchases. What's the take here? What does it mean for you as a shareholder?
The letter strongly defends value-accretive repurchases. That means buying back shares when they are priced below their intrinsic value.
So buying low.
Effectively, yes. Berkshire bought back 1.2% of its own shares in 2022. Plus, companies they invest heavily in, like Apple and American Express, also bought back shares.
And that helps Berkshire how?
It increases Berkshire's ownership percentage in those great companies without them having to spend another dime.
Oh, okay.
The letter uses a great analogy. Imagine 3 partners own an auto dealership. One partner decides to leave and sells their share back to the dealership at a fair, maybe even attractive price.
Right.
The 2 remaining partners now automatically own a larger slice of the same business, increasing their share of future profits just because the company bought out the departing partner. It benefits the continuing shareholders.
That makes perfect sense. Yet, repurchases often get criticized.
They do. And the letter pushes back hard, stating that people who claim all repurchases are harmful are either an economic illiterate or a silver-tongued demagogue.
Oh, strong word.
Very direct. It's a clear defense of repurchases done right when they genuinely increase the per-share value for the remaining owners.
But importantly, the letter also includes a warning, right?
Yeah.
Even about those preferred operating earnings.
Yes, a crucial one. Even operating earnings can easily be manipulated by managers.
So even the better number isn't foolproof.
Exactly. And the letter doesn't mince words about that either. That activity is disgusting. It requires no talent to manipulate numbers. Only a deep desire to deceive is required.
A stark reminder to stay vigilant, even with seemingly reliable figures.
Absolutely. Always critical thinking required.
Okay, let's broaden the lens a bit. The letter talks about the historical context, the national backdrop against which Berkshire grew.
Yeah, and what's fascinating here is the perspective on the wider economic environment. Berkshire started, remember, in 1965 as basically a failing textile mill in New England. Doomed, the letter calls it.
Right. Seemed like a dead end.
The big shift was buying National Indemnity in 1967, getting into insurance. But the letter credits a lot of the subsequent success to something bigger, the American tailwind.
The American tailwind. What does that mean?
It's this idea that the general prosperity, innovation, and growth of the U.S. economy provided this massive propelling force. The quote is very clear. America would have done fine without Berkshire. The reverse is not true.
A sense of humility there and acknowledgement of the system.
Definitely. A deep appreciation for the opportunities that the American economic system provided over those decades.
And building on that national context, the letter shares some really eye-opening facts about federal taxes.
Yeah, the numbers are pretty mind-boggling. The U.S. Treasury took in about $32.3 trillion in taxes, but spent around $43.9 trillion in the decade ending 2021. Huge figures.
And they say predicting the economy short-term is pointless given those scales.
Worse than useless is the phrase used. But then comes the kicker about Berkshire's own contribution.
Okay.
Over that same decade, Berkshire paid $32 billion in corporate income taxes. That amount, $32 billion, was almost exactly 0.1% of all the money the Treasury collected.
0.1% from just one company.
Yes. And then comes the really startling brace yourself fact, as the letter puts it.
What's that?
If you could find just roughly 1,000 taxpayers in the U.S. matching Berkshire's payments.
Okay, 1,000 companies or individuals paying that much.
Then no other businesses, nor any of the country's 131 million households would have needed to pay any taxes to the federal government.
Yeah.
Not a dime.
That puts it in perspective. Just 1,000 entities could cover the entire federal tax bill if they paid at Berkshire's level.
It's an incredible statistic.
We need a way to visualize $32 billion. The letter gives these analogies. $1 million in $100 bills is a stack up to your chest.
Oh, right.
$1 billion. That stack hits about 3/4 of a mile high.
Still hard to picture, almost.
But $32 billion, Berkshire's tax contribution, that stack of $100 bills, would be over 21 miles high.
21 miles.
That's like 3 times the cruising altitude of a commercial jet.
It just underscores the immense scale. And despite seeing this huge fiscal numbers, the underlying message from the investor remains deeply optimistic about the U.S.
Still bullish on America.
Unwavering. Never seen a time when it made sense to make a long-term bet against America. That really sums up their foundational belief.
Okay, from the big picture of America, let's zoom into a key relationship, the partnership. The letter includes a section dedicated to the wisdom of Charlie Munger. Always a highlight.
Oh, absolutely. And connecting this back, Munger's genius often lies in distilling really complex ideas into these incredibly clear, memorable principles.
Buffett acknowledges that Munger's versions are often sharper, maybe more blunt.
Yes. More clearly reasoned and also more artfully, some might add, bluntly stated. That's the quote.
So let's share some of those Mungerisms. They offer so much practical wisdom for anyone listening.
Definitely. Let's start with one that echoes our earlier discussion. The world is full of foolish gamblers, and they will not do as well as the patient investor.
Straight to the point. Patience versus gambling. Why do you think that one hits so hard?
Well, in today's world, everything's about speed, right? Instant results. This is just fundamentally countercultural. It's saying, no, the real advantage is resisting that urge, embracing the slow build. It's a marathon, not a sprint.
So true. What else? He talks about seeing things clearly.
Yes. If you don't see the world the way it is, it's like judging something through a distorted lens. It's about realism, about intellectual honesty, facing facts even when they're uncomfortable.
That's crucial. And he had that funny but profound one about avoiding problems.
Right. All I want to know is where I'm going to die, so I'll never go there. It sounds simple, but it's about inversion, figuring out what not to do. Identify the big mistakes, the potential catastrophes, and just avoid them. It's often easier than trying to be brilliant all the time.
Proactive avoidance. Makes sense. And he believed patience could be developed.
He did. Patience can be learned. Having a long attention span and the ability to concentrate on one thing for a long time is a huge advantage. He saw it as a skill, something you can cultivate, which is quite empowering, actually.
That's a great point. It's not just something you're born with. What about learning and adapting?
Oh, hugely important. He advised, you can learn a lot from dead people. Read of the deceased you admire and detest. Learn from history, basically. See what worked, what failed.
Don't reinvent the wheel or repeat mistakes.
Exactly. And related to that is adaptability, knowing when to change course. His quote, don't bail away in a sinking boat if you can swim to one that is seaworthy.
Makes sense. Stick with winners, cut losers.
And knowing when a company is truly great versus mediocre, a great company keeps working after you are not. A mediocre company won't do that.
Thinking really long-term there, beyond your own involvement.
Right, and he reiterated their focus. Warren and I don't focus on the froth of the market. We seek out good long-term investments and stubbornly hold them for a long time. Echoing Ben Graham. Day to day, the stock market is a voting machine. In the long term, it's a weighing machine.
Weighing the actual substance of the business over time.
Precisely. He also warned strongly against leverage. There is no such thing as a 100% sure thing when investing. Thus, the use of leverage is dangerous.
A critical risk management point. And you mentioned adaptability earlier, the railroad example.
Yes, a fantastic example. They admitted they hated railroad stocks for decades, but the industry changed, consolidated, became more efficient and essential.
So they changed their minds.
They did. They recognized the four major railroads were vital to the economy. Munger noted they were slow to recognize the change, but better late than never. It shows humility and the willingness to adapt, even late in their careers.
That's a powerful lesson in itself. And of course, we have to mention his famous sign-off.
The ultimate decision clincher for decades. Warren, think more about it. You're smart and I'm right.
Classic. Sums up that legendary partnership.
It really does. And Buffett adds his own rule to Munger's list. Find a very smart, high-grade partner, preferably slightly older than you, and then listen very carefully to what he says.
Sage advice. Okay, so stepping back from the specific strategies and quotes, what does this all tell us about the human side of Berkshire, the culture?
Well, it really emphasizes the deep, deep trust between management and the shareholders. It's not just a transactional relationship.
How so?
The letter talks about how the disposition of money unmasks humans and expresses real pleasure in seeing the vast flow of Berkshire-generated funds to public needs from long-term shareholders who've become wealthy and then philanthropic. There's a sense of shared purpose almost.
That's a dimension you don't often hear about. And speaking of the human side, there's that lovely story about the annual meeting, the family gathering in Omaha, and the See's candy sales.
Oh, it's brilliant. It illustrates so much. They sold 11 tons of candy.
11 tons.
Generated over $400,000 in just 2 days from one kiosk. And the kicker, the products haven't been materially altered in 101 years.
Wow. So the lesson there is...
The lesson is powerful. What worked for See's in the days of Henry Ford's Model T works now. It's this idea that fundamental business principles, quality product, good service, brand loyalty are timeless. They don't really change, even if the world around them does. It's a perfect metaphor for their whole investment philosophy.
Enduring principles trumping fleeting trends. So as we wrap up this deep dive, what does it all mean for you, the listener? How can you apply this?
I think it really boils down to a few core ideas we've hit on. The immense power of thinking long-term, the absolute necessity of understanding the underlying business you're investing in, whether it's with your money, your time, your career.
Patience.
Patience, yes, the virtue of patience. The almost magical effect of compounding over time. And finally, the critical role of trust and finding good partners, whether in business or life. These aren't just finance lessons, are they?
Not at all. They feel much broader. And maybe building on Munger's advice to learn from the past and Buffett's faith in that American tailwind, perhaps the final thought for you to consider is this. In our world of constant noise and rapid change, what fundamental timeless principles might you be overlooking? In your work, your decisions, your life? What are the real long-term bets you're making? And what are those enduring forces, those tailwinds, that might be quietly shaping your own success, maybe without you even fully realizing it? Something to reflect on.